In today's video, we'll do a detailed comparison between two popular mid-cap funds which are having the highest AUM in the mid-cap segment. These funds are Kotak Emerging Equity Fund and HDFC Mid Cap Fund, and also try to understand which one is better and in which fund one should invest. So please watch the video till the end. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. So let's start the video with the basic details. Firstly, for Kotak Emerging Equity Fund, the AUM, that is the total asset under management, which is more than 27,870 crores. The expense ratio is 0.39%, which is quite low as compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is NIFTY Mid Cap 150 TRI. Now let's look at the basic details for HDFC Mid Cap Fund. Here, the AUM is around 39,300 crores, which is one of the highest in the mid-cap category. The expense ratio is 0.91%, which is quite high as compared to other schemes. The benchmark index is NIFTY Mid-Cap 150 TRI. Now let's look at the sector-wise allocation. Firstly, for Kotak Emerging Equity Fund, from the table, it is very clear that the fund has the highest allocation to capital goods sector, followed by finance, materials, and chemicals. Now let's look for HDFC Mid Cap Fund. Here, the highest allocation is to the financial sector, followed by capital goods and healthcare. And when we compare this allocation to its category, it is quite different for both the funds. Now let's check the portfolio allocation. Firstly, for Kotak Emerging Equity Fund. As evident, mid-cap shares form around 76% of the portfolio, whereas large cap shares form other 21% of the portfolio, and rest around 3% is allocated to small cap stocks. Here, the portfolio seems quite balanced with around 76 stocks in the portfolio, and top 10 stocks form around 31% of the portfolio, and top 3 sectors form around 43% of the portfolio. Now let's also look at the portfolio allocation for HDFC Mid Cap Fund. Here, more than 63% is allocated to mid cap stocks, whereas large cap stocks form around 26% of the portfolio, and rest 11% is allocated to small cap stocks. The portfolio seems not so diversified, as the portfolio is having 62 stocks, with top 10 stocks contributing to around 35% of the portfolio, whereas top 3 sectors contribute to around 47% of the portfolio. Here, if you observe, both the funds are having similar approach in the portfolio allocation, and both the funds follow a buy and hold strategy, as the turnover ratios for both the funds are 2.55% and 12.36% respectively. Now let's look at the top holdings. Firstly, let's look for Kotak Emerging Equity Fund. As evident, Cummins India, Schaeffler India, SKF India, and Thermex are the main stocks of the capital goods sector, whereas Supreme Industries, Kajaria Ceramics, and JK Cement are from the material sector. Now let's look for HDFC Mid Cap Fund. Here, Cholamandalam Finance is the main stock of the financial sector, whereas Hindustan Aeronautics, Bharat Electronics, and Sundaram Fasteners are the main stock of the capital goods sector. Here, the overlapping between the funds is around 27%, and none of the 10 top stocks are common in the portfolio. Hence, you can have both the funds in the portfolio. But the question is, are they really that good to have in the portfolio? Let's try to understand in the later part of the video. Now let's also look at the fund managers. Firstly, for Kotak Emerging Equity Fund, Mr. Pankaj Tibrewal has been managing the fund since January 2013, that is, from the inception of the scheme. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's look for HDFC Mid Cap Fund. Here, Mr. Chirag Setalwad has also been managing the scheme from January 2013. Hence, we can say that both the funds have the same fund managers since the inception of the scheme, which is quite good and an advantage for the scheme. Now let's look at the trailing returns. Firstly, for Kotak Emerging Equity Fund. On comparing the trailing returns for the period 3 years and more, it is able to beat its benchmark and the category. But if you see, for 1 year and less, it struggles to beat its benchmark and the category. This is not a good sign. Surely, 1 year performance should not be a yardstick to judge the performance of the fund, but this is an alarm, and investors should surely keep an eye on the fund's performance. Now let's check the trailing returns for HDFC Mid Cap Fund. Here, if you observe, for the entire period, the fund is able to beat its benchmark and the category, and that too, especially in last 1 year, it is able to beat with a good margin. Hence, we can conclude that here the fund's performance is good and is improving in last 1 or 2 years. Now let's compare the calendar returns and see how consistent the funds are. Firstly, for Kotak Emerging Equity Fund, here we have data from 2014 to 2022 and also till date for this year. That is 10 years data here. If you observe, the fund is able to beat its benchmark and category 9 times out of 10, which clearly makes the fund quite consistent in its performance. Now let's look for HDFC Mid Cap Fund. Here, it is able to beat its benchmark 8 out of 10 times and the category 5 out of 10 times. Hence, it can be concluded that the fund is less consistent than Kotak Emerging Equity Fund. Now let's also check the SIP returns before checking the rolling returns. Here, we have taken monthly SIP of 10,000 rupees for 10 years. Hence, the invested amount after 10 years would be rupees 12 lakhs, whereas total corpus of Kotak Emerging Equity Fund would be rupees 35 lakhs 36,000, which translates to 20.51% of annualized return. Whereas for HDFC Mid Cap Fund, it would be 33 lakhs 42,000, which is 19.46% annualized return. Here, the performance of Kotak is slightly better than HDFC Fund. Now let's quickly check the rolling returns. Here, we'll check the rolling returns for 1 year, 3 year, and 5 year and compare it to its index. Firstly, let's see the 1 year rolling returns. From the graph, it is evident that both the funds have been able to beat its index 88% times and 81% of times, with Kotak having a better average returns and a little higher standard deviation. Now let's see for 3 years. Here also, both the funds have been able to beat its index 100% of times, with Kotak having a little better average returns and little higher volatility. Now let's also check 5 years rolling return. Here also, both the funds are able to beat its index 100% of times, with Kotak having a better average returns and a lesser volatility. Hence, from the rolling returns, it can be concluded that both the funds are able to beat its index 100% of times for 3 years and 5 years period, and the average return of Kotak Emerging Equity Fund is better than that of HDFC Mid Cap Fund. Now let's see how the funds performs on risk parameters. Firstly, for Kotak Emerging Equity Fund, first one, mean returns, that is the average return in a year, which is 32.65, which is more than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 15.05, which is less than both the benchmark index and the category. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk-adjusted return, which is 1.90, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to its benchmark, which is 0.90, which is same as the category average. Here, lower the value is better. Alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 3.21, which is higher than the category average. Here, higher the value is better. Now let's look for HDFC Mid Cap Fund. Here, the standard deviation and the beta values are not better than the benchmark index and the category, which indicates that the fund is little more volatile than the index and the category, but it is able to generate better returns than Kotak Emerging Equity Fund. Now let's see the upside and downside capture ratios. Firstly, for Kotak Emerging Equity Fund, the upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 98, which indicates that the fund underperformed 2% than the index during this rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index is dropped. Here, the value is 68, which indicates that the fund declined 68% as compared to the index during the fall period. Here, lower the value is better. Now let's check for HDFC fund. Here, the upside capture ratio is 101, which indicates that the fund outperformed 1% more than the index when the index rose. The downside capture ratio is 68, which indicates that the fund also declined 68% as compared to the index during this fall period. Here, lower the value is better. On comparing for both the funds, the upside and downside capture ratios for both the funds are almost same. Hence, cannot conclude which fund has a better capture ratios. So now let's see what investors should do. But before suggesting what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future. So coming back to the conclusion, what investors should do. First, the existing investors. Firstly, for Kotak Emerging Equity Fund, the fund's performance has been average in long run and has been able to beat its category and index, but not with a huge margin. So you can continue your investment in this fund as it is quite a consistent performer, as the fund has been underperforming since last 6 months and should keep an eye on it. Now for HDFC Mid Cap Fund. The fund's performance has been average in the past, but since last 2 years, the fund's performance has been improving and hence can safely continue their investment in this fund. But do keep an eye on the fund's performance as it is not very consistent in its performance. New investors. I feel that both the funds have an average performance, and if investors have narrowed down the choice to these two funds and want to choose between these two only, then I feel that looking at the performance, risk parameters and the stock portfolio, Kotak Emerging Equity Fund would be my choice. What do you feel? Which one would you select? Do share your views and comments in the comment section. Instead of selecting any of these funds, you can also look at other options like Quant, PGIM, SBI, etc. also. I would like to add that I have Kotak Emerging Equity Fund in my portfolio and will be continuing my investment in this fund. I will again try to review this fund separately after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you are not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.